Uh, Hello, everyone. Let's get started, if we can. I I suppose after the last panel, the first thing to do is why don't we take a vote to find out whether the fault in the system is Josh Sussberg and Kirkland or Damien Shabel. Okay. Okay. Thanks, everyone. I'm introducing the next. Okay. Introducing the next panel. It's a great panel on distressed investing in Asia, and you all know about all the situations going on there. The moderator of the panel is our old friend Bill Brandt, who's the founder and chief executive for chairman of Development Specialists, Inc. Bill is just a staple of the industry. He's been involved in everything from formulating the bankruptcy legislation to doing major workouts to being involved with the very largest cross-national proceedings, including recently being involved with the largest one in China, fisheries. So anyway, everyone knows Bill, and I'll turn it over to Bill.
Thank you. I'm joined today by two really well-known panelists, good friends of mine as well. Mark Bloom, to my immediate left, who is a partner in the Global Restructuring and Insolvency Practice Group at Baker McKenzie, where he devotes the bulk of his practice to advising various stakeholders in complex multinational situations. He, like I, is a member of the International Insolvency Institute, has written and presented on a variety of cross-border matters for Insol, for the New York State Bar Association, and he currently serves as the chair of the American College of Bankruptcy. To my farther left is a good friend, John Pintarelli from Pillsbury here in New York. John represents debtors and creditors in complex domestic and international bankruptcy and insolvency matters, including judicial and out-of-court restructurings. John regularly advises clients in the structuring of debtor in possession and exit financing, and has done so in connection with the Asian market. He also advises on loan restructurings, asset sales, and acquisitions, reminiscent of the last panel's discussion. And before entering into private practice, John served as a vice president in the Bank of New York's Middle East, Eastern Europe, and Africa group, where he was responsible for the bank's Arabian Gulf relationship. So we've got a fair amount of international expertise here. Hopefully, we can hold your attention for about 45 minutes or so to tell you what's going on in Asia. As many of you know, in 1996, former President Clinton loaned me to the Politburo to work on the restructurings of state-owned industries. So I spent a good bit of 97 and 98 going back and forth working out SOEs for China. The education I got wasn't so much in SOEs, but measurably in Chinese politics. And I think as we start this panel this morning, the issue I wish to address is really Chinese politics. And I think my two fellow panelists are going to speak to that same issue as well. The question I get all the time about Evergrande and its brethren, is this a layman moment for China? And the answer simply is no. China will not permit this to be a layman moment, even though Evergrande, for example, is involved right now in over 770 projects in 223 separate cities in the mainland, has about 300 billion in debt, so will be, if something happens, the largest insolvency any of us have ever seen. 20 billion of that debt, as John will talk about later, trades on the international market under New York indentures. And right now, it's reputed to be that the debt that Evergrande holds represents about 6.5% of the total liability for the entire Chinese property sector. You know, people ask me about this all the time going back to 96. The Chinese economy is not the behemoth we all think it is. I remember in the 1980s how Japan was going to own us shortly. I often feel that reminiscent of that when I hear about China these days. China has continued to manufacture growth, even though after the one-child policy, a significant amount of its population is aging. Its population is not as aged as Japan's, but it's aging out. And this has become, the outcome of this is much slower growth. So what do you do to make up for slower growth when you have an aging situation that is not immediately remediable? You do two things. You encourage migration from the rural areas to the cities for jobs. And secondly, you borrow every bit of technological expertise you can from every other advanced nation, whether by hook, crook, or illegally in the world. And they've done that very well. The result of this migration and these other efforts has been essentially a housing bubble. As George Soros pointed out in the Wall Street Journal in October, the Chinese are living in a housing bubble right now, which is eerily reminiscent of what was going on in the US in 05 and 06. The question is, will they let it pop like we did with Lehman, or will they bring it down? The long and short of that is, the Chinese market is really not integrated internationally. I know we all think otherwise given the trade with China, but it's not. There are significant capital controls, very strict capital controls, both on the movement of capital into and out of China, which parenthetically, by the way, is why the yuan or renminbi is never really going to become the world's reserve currency in the next 10 years. It simply can't trade freely. So what's going to happen with respect to this? I'd like to talk to my fellow panelists about this over the course and have a debate. But frankly, I mean, Premier Xi has established the 3 red lines, which Mark is going to talk about. But the net effect is that the Chinese are going to wind this down slowly. The major impact of all of this is on local governments. Local governments in China derive their primary tax income from fees associated with real estate transfers. Right now, about 70% of the personal wealth in China is tied up in real estate ownership in their homes. So there is a lot to be done with respect to how we bring this down. In addition to that home ownership bubble, there are significant investments by the Chinese retail market in Evergrande and other similar property developments. It's not just Evergrande. The Politburo was sending a message, just like they sent to Jack Ma about a year ago, about how they plan to run these shows. When I was first going to China, working under the group that was responsible to Deng Xiaoping, I learned an essential fact about the Chinese economy. There are 2 factions in China and have been for about 50 years. There are the mercantilists, and I will maintain that between the Dutch and the Chinese, they are the 2 best mercantilists in the world, and they go back thousands of years. And the other side is the survivors of the Long March, the people who are true believers in Mao and what the revolution wrote. Deng Xiaoping was a mercantilist, and everything you see advancing in China reflects that. Premier Xi is the grandson of a Long March survivor. And we are going back from private enterprise growth under Deng Xiaoping to state-owned industries. The state will have an amazing role to play in virtually every economic decision made, all the way down to the most minute level. Will they go back to the state-owned industries of the 70s and 80s? I doubt that they will directly own the means of production, but through investments and board placements, they are likely to control the means of production, and that's a pretty important issue. So what's going to happen? The Chinese will wind this down. Obviously, given their bond market in China, which is already subject to some substantial defaults, you're going to see a lot of slower economic growth. What does that mean for the rest of the world? A real quick takeaway for me is it will not result in a Lehman moment, but it will result in lower consumer spending in China. And lower consumer spending and lower government spending in China means a lower amount of imports to China. And in the Chinese market, the lower amount of imports is going to first manifest itself in raw materials. Iron and copper from Australia, rubber from Malaysia, and the rest of it. That's what you're going to see, so those prices will begin to drop as that demand goes down. But make no mistake about it, given where Premier Xi is, he will let the air out of this tire very slowly, and there will be no Lehman moment. There will be examples made, for example, as I was talking to John, the richest man in China right now is the current equity holder and founder of Evergrande. That is a temporal situation, obviously, like Jack Ma was once the richest guy. Mr. Wan has just kicked in $1 billion last week under, let's just say, cooperative structures in China to help the Evergrande. He is expected to kick in more, and if you were looking for something resembling what it's like in the U.S., the Purdue Pharma issue is kind of similar. We're going to see the majority of the wealth derived from Evergrande kind of circle back into Evergrande at some point, and there won't be the kind of bargaining the Sacklers were able to do. Premier Xi cuts a harder deal, if you will. So going on from there, I want to get the conversation going first with Mr. Bloom, who wants to talk about the famous 3 red lines that Premier Xi has kicked around, and as well, where the Chinese market is going for insolvency in general. Mark?
So thank you, Bill, and good morning, everyone. Thank you to the Beard Group and all the fine sponsors for the opportunity to participate today. You know, I listened intently to the outstanding and entertaining panel of 6 experts that just sat up here and tried to debate the very complex topic of real estate valuation in a pandemic. And now I'm wondering how this panel of 3 is going to manage to address the equally complex and perhaps less predictable topic of what might happen in China and across Asia, given current political and economic concerns. So, notwithstanding that, we'll give it a try, and we'll start with a focus on China, which of course is a topic all to itself, as Bill's remarks suggest, and a reminder to our panel to circle back or intersperse, at least at some point in time, to offer some observations about other Asia-Pacific nations that may have similar or very different but profound situations going on that affect the value and the trading in their foreign-held, foreign-traded debt as well. So let me start with a proposition that hopefully is not too small on that slide for everyone to see, but this is intended to help frame the discussion. And that proposition is, whatever the political, economic, and social priorities of the current Chinese leadership may be, providing safe haven, comfort, and easy repatriation of capital for foreign investors is not at the top of that list.
Not even near the top, right?
Not even near the top. Yeah. Not even near the top. And of course, that's a different experience than you see in a lot of other, let's say, less muscular, less equal nations that may rely more heavily across Asia, Latin America particularly, upon foreign-held investment emanating from major money centers like New York, London, Singapore, Hong Kong. One of the keys to this is that unlike Western nations, of course, China doesn't have election cycles. And so having abolished term limits for his office a while ago, President Xi intends to rule indefinitely. Given his age, I think a lot of insiders are looking at perhaps 2035. Without question, he'll be reelected to another term by a similar majority in the National People's Congress as that which voted to abolish the term limits in the first place. And despite the obvious drawbacks to perpetual rule of that nature, the effect is to enable him to take a longer range view, and for he and his government to pursue policies over the next dozen years or more. You see an asterisk that we won't talk about, but that really is a long-term objective that dictates a lot of other policy thinking. Among other things, these policy initiatives involve an effort to reduce debt and leverage in various sectors, including real estate. That said, there also is the populist motive to try to keep property and housing prices from going any higher in order to be able to stimulate the growth and the migration of the population that Bill talked about, so as to be able to sustain economic growth through employment. Clearly, there are other priorities behind the push to deleverage the largest issuers of funded debt, specifically including those in the real estate sector, and that sector comprises an unsustainable 25% of the growth of the Chinese economy right now. Earlier this year, as Bill mentioned, the 3 red lines were established. You see the 3 thresholds there listed on the screen. These were established by the People's Bank of China, which is something of a change in policy in and of itself, a significant change, because historically the oversight by PBOC has been quite lax. This is done in conjunction with the Ministry of Housing, and you see the 3 thresholds on financial borrowings that are established. Now, there is a carrot that is held out to those companies in the real estate sector that can comply on an annual basis with those 3 red lines, or color within those 3 red lines. If all 3 are met on an annual basis, then the company is allowed to increase its funded debt by up to 15% in the next year. So there is an incentive to stay within these ratios in order to be able to continue or sustain growth through increased leverage. But the very fact that these 3 red lines were established reflects, I think, the intensity of the governmental focus on the real estate sector, given the high leverage and the overall impact on the Chinese economy. In addition to some of the statistics that Bill offered, 28% of Chinese bank loans are in the housing sector. And so that poses an interesting balancing act for the Chinese policymakers. While they're looking to deleverage these companies, at the same time, they don't want to discourage banks from lending into this sector. The system is hardly foolproof. And let me turn it over to John to talk about some of the, John, should we call them gimmicks or use of off-balance sheet and other devices that may trap capital and make it more difficult for investors, foreign investors, to get hold of at the top of the stack?
Well, some of the gimmicks or, off-balance sheet structures that the real estate developers have been using have been to sell non-core assets to favored friends with a putback. So in effect, you're getting cash now, but it's basically a secured loan by Hong Kong traded securities. The other thing that a number of the developers are doing land swaps with creditors in order to keep the development projects going, moving forward. But there's a lack of transparency with those deals, and it's unclear the extent of the deals that are being done by the developers. I know Evergrande had just recently announced that they sold undeveloped land back to the PRC for $200 million, and that was for its EV unit. It's unclear whether that land was actually owned by the EV unit or whether it was owned by the development arm. So there's a lot of intercompany transactions going on amongst the Evergrande subsidiaries that's not transparent to investors.
And John, when you talk about that, I mean, fresh off China fishery as I am, I recognize that a host of mainland Chinese companies are taking advantage of incorporating parents in the BVI, the Cayman, Bermuda, and others. And even those holding companies then own further companies downstream in Hong Kong that may list long before you get to the Chinese assets. So, when you talk about transparency, isn't that one of the problems you're seeing as well?
Well, it's one of the biggest problems. For example, Evergrande, their offshore debt has been issued by a BVI company or a Cayman company. It's been guaranteed, for example, the China Evergrande debt has been guaranteed by other offshore entities, but has not been guaranteed by any PRC entities. So when you're looking to, if there's a default and you're looking to foreclose on that, you're basically going to hit a wall once you get to the PRC holdcos.
And is that because basically Evergrande and its brethren, Cynic and the others, really have no assets that you can attach outside of mainland China? Is that correct? Well,
Evergrande does have some subsidiaries that specifically hold Hong Kong listed companies, but as you can tell, those assets, the valuations are fluctuating and changing day to day. For example, was it the China Evergrande just sold Hang Ten, the rest of their their holdings in Hang Ten for a 40% discount to what they sold the shares for recently in as recent as August. So even though there are offshore, Hong Kong listed assets that a creditor in the of the BVI or the Cayman structures can attach, they're very limited in scope, and they're not the real hard assets, the real estate assets in the PRC.
So some of my friends, John and Bill, in the offshore jurisdictions are telling me that one of the reasons, and there of course are many, for the use of these Cayman and BVI holding companies, I think it may primarily be Cayman, but whatever the reason, whatever the difference, one of the reasons for the use of these companies is to be able to list the parent on foreign exchanges, the debt and equity securities in the U.S. and elsewhere on foreign exchanges. And what they have been very quietly doing is delisting from those exchanges in order to relist in China in a friendlier and perhaps more controlled environment. And I understand that there's something of a cottage industry, at least in Cayman, with distressed debt investors buying up some of these positions and then petitioning the Cayman courts for evaluation and redemption of their interests under Cayman law. I don't know whether either of you have any thoughts or any comments or experience about that.
Well, I think as far as the buying equity securities and doing evaluation, there is a lot of distressed capital sitting on the sidelines, and so you have investors that have made it a portfolio decision where they are going to invest in a diverse range of PRC companies that they believe are going to be delisted, and it is their strategic goal to get some upside value, bring a lawsuit in the Cayman Islands, very much similar to a Delaware valuation fight on a going private transaction. And they've been able to settle at, generally the terms are 15 to 20% markups from the going private price, and therefore if you hit 2, 3, 4 of those, you're making decent money rather than just having money parked on the sidelines.
And another consideration is the fact that if you are listed in Hong Kong or Singapore and you want to sell assets even downstream several subsidiaries below, you need the approval of the exchanges with respect to asset ratios and how much you're selling. And that is, in Singapore's case, it's hard to come by, a little easier in Hong Kong. The fact of the matter is if you can delist from both of those and relist in Shanghai or Beijing, especially Shanghai, that necessity for approval to move assets around at a lower level and get an exchange sign-off is almost de rigueur in Shanghai, not so much in Singapore or Hong Kong.
So let's go to the E portion here, because E is for elephant, and of course the elephant in this conversation is Evergrande, which also starts with E. And Bill's question about whether it's too big to fail. How big is it? It is by far the dominant issuer of debt securities, posing the greatest risk to the market, but it goes beyond that. Some of the statistics that you see there, including the figure that Bill gave about the amount of U.S. dollar-denominated bonds that are outstanding, that amount represents 16% of China's high-yield dollar bonds, 11% of all of Asia high-yield dollar bonds, and think about that for a moment as you look to the entire region. 16% of China bonds, 11% of all Asia bonds, but only 3% of China's total dollar bonds. And as you start to roll those concepts around in your head, I think it helps give you an answer to the question about whether it is too big to fail, whether the government will bail it out or rescue it, or whether there would be some more controlled letting the air out of the bubble, as Bill referred to before. When I put together this slide that said, if Evergrande were to default, and that offered some thoughts courtesy of Merrill Lynch advisors, one of the people who I asked to review it said I should change if to when. While Evergrande made the recent debt coupon payment, the general consensus, as I understand it, is that absent direct government investment, which is not likely to occur, it is highly doubtful that Evergrande will be able to continue through the remainder of the debt terms to be able to issue, to make interest payments on a timely basis. So if/when Evergreen were to default, Merrill Lynch predicts that the default rate for the Chinese high-yield dollar bond would increase from the present 4% to 20%, a 5-time increase in the default ratio for bonds. And within Asia overall, increase from 3% to 14%. So as we go to the next slide, let me invite John and Bill to jump in at any point as we begin to talk about some of the significant hurdles for investors to overcome to realize value in the foreign law-denominated bonds, specifically the U.S. dollar-denominated New York law-governed bonds.
You know, we talked about this as we were preparing for the panel. You all kind of focus on Evergrande as China's Lehman moment. I will tell you there are 2 other large bankruptcies that the U.S. had that weren't Lehman, that on the heels of seeing what happened in Lehman, the government took a more direct hand. They were called bankruptcies, they were called insolvencies, but by any measure, the United States government dictated the outcome of those cases, I'm talking General Motors and Chrysler, and ran them through despite what would be the normal practices in bankruptcy court. So I don't see China Evergrande filing for an insolvency outside of China. It might file in Shanghai if it does under the new PRC code. But I think what you're looking at is something, if it does begin to default and the government isn't willing to put enough money in to prop it up, which is a problem because I want John to talk about housing stability. One of the issues that China faces, they looked in horror years ago at both the era of Mao and Yeltsin's revolution in Russia. They do not want festering activity in the streets. They're already seeing some of this in some of the Evergrande developments where people are moving into unfinished houses because they have a deposit. This kind of disorder they don't favor. So they may do something and engineer a failure, but look for something much more along the lines of General Motors or Chrysler by analogy than Lehman. And if that's the case, it will be engineered primarily for the Chinese market. Wouldn't you agree, John?
Yes, and there's about 1.4, just for Evergrande, there's about 1.4 million housing units that have already been pre-sold but not yet delivered. So I can very much see the government taking over those projects, or perhaps marrying Evergrande with a non-levered competitor to take over those projects and deliver them. One of the issues, you mentioned whether it's going to file in the offshore world. Bondholders may, if there is a default, bondholders can seek to wind up the companies in Cayman or BVI where the entity is listed, potentially Hong Kong as well, where the main operations are. But the issue there is that those bankruptcies are unlikely to be recognized in the PRC because, the PRC does have similar to the U.S., they do have a Comey analysis, and all of the operating assets are in the PRC. So you're going to have an onshore solution, and it's going to be guided by, the government's hand. One of the issues as to, with investors in the bonds, they're going to want a quick return. Realizing asset sales has been proven to be elusive for Evergrande. They tried to sell their headquarters for about $1.7 billion. That fell through. They tried to sell 50% of their property management company for about $2.6 billion. That fell through. And what they did, as I mentioned earlier, what they were able to do is sell the remaining stake in Hang Ten for about $1.24 Hong Kong dollars per share, which is 40% less than what they sold it for just in August. So.
John, wasn't there, you and I were chatting about this in the quiet Thanksgiving week in the U.S. There was an auction attempt at some of the real estate in China just last week or the end of the week before, not giving a great signal for upholding housing value. Talk about that a bit.
Well, there was an auction. Obviously, the local governments, about 30% of their revenues comes from the sale of land sales, and they held an auction recently in which the pricing of the land was 20%. The auction price, the bid price or opening bid price, was 20% below their prior auction, and more than half of the auction lots were pulled because there were no bidders for them. So that's going to be a value problem.
Let me guess, foreign bidders were not encouraged to participate?
No.
Okay, just a guess.
Yeah, and you can be sure that the mandarins in Beijing were very much attuned to the fact that the properties were pulled and were in approval of that rather than seeing the housing market, if you will, decline in value. That's a key indication of how they plan to keep a lid on social unrest.
And the foundation for the portion of the discussion that you just observed here is really on the slide that is displayed right now, that relates the complex capital structure of Evergrande. And I don't know, John, you mentioned in one of our discussions the intermediate holdcos that can trap the potential upstream value to pay the bonds. You have anything more to add about that, or did you take it on before, you think?
Well, I took it on before, but
Okay.
the one thing to say is all of the bondholders, basically, you should be looking at equity value. Assume that your equity, your offshore equity,
Deep
And-
equity.
Maybe you get a hope note. Maybe
And
you'll
the
get
Hope Note, as I recall, will be redeemed in full about the time the Starship Enterprise returns from its last trip around the universe, okay?
Well, and that's what some of the other developers have been going out, trying to get extended terms for their bondholders, 18 months, 2 years, 3 years. I don't think this problem is going to unwind in that period of time. But there are, for the bondholders in Evergrande specifically, you have, again, the China Evergrande bonds are about 2 levels further removed than the scenery bondholders, who actually have a keep well from a PRC entity. However, even that PRC entity is about 6 levels away from the operating assets. So you have to go through many levels of an equity liquidation in order to get a dividend up to any of the entities that are liable on these debts. It's just going to be a difficult slug.
And to relate this part of the discussion back to the proposition from which we started about the repatriation and safe haven of capital for foreign investors not being a high priority, you see here the more holistic view of the overall debt structure. As of June 21, the bank borrowings were of $60 billion US within China, 3 times the amount of the debt instruments that we're talking about. The trade credit obligations were even larger, 220 billion, 11 times the indebtedness under the foreign bonds. Some within China are suggesting, or more likely some outside of China are projecting that there may be some type of informal subordination among these trade creditors with some government incentives to subordinate in that manner so as to permit debt service payments to continue to banks and on bond debt while the government and Evergrande exhaust the various avenues that they may have to figure out their next move. And one of the reasons for that is because Evergrande, not surprisingly, is the largest customer to many of the suppliers and the construction companies it works with, and the impact of a free-fall type bankruptcy for Evergrande, the impact on those tens of thousands of counterparties would be nothing short of disastrous. I think we've already talked about...
And I would just add that if you look at the amount of employment in China, of course, everything in China is by a factor of 10, but over 3.5 million people are employed by either Evergrande or its indirect or direct subsidiaries. So this is not only an issue for the homeowners who have pre-sold units, but there are 3.5 million employees in these 223 different cities, including the headquarters, a major issue for China's social policy with respect to keeping the lid on rest of populations.
So, John, as tempting as it is to talk about Evergrande for however much time we have remaining here, let me ask you to go beyond that and talk about your slide that speaks more broadly about the China housing market and where we find it.
So the Chinese real estate developers have debts of approximately $5.2 trillion. 46% of that is bank debt, and only 10% is bond debt, of which 217 billion is denominated in U.S. dollars. So the foreign denominated debt is such a small, it's literally a blip on the screen radar for the Chinese developers. And debt service is becoming more and more of an issue because liquidity is squeezed. In September of 2021, for the top 100 developers, sales were down 36% year over year, and for the top 10 developers, it was down 44% year over year. They're slashing prices in order to generate sales, but that's impacting margins and obviously cash flow. So you're robbing Peter to pay Paul. And as we talked about earlier, Evergrande has over 1,000 projects in 233 cities, 1.4 million housing units already pre-sold that have not been delivered. And that's where we think the government's going to intercede and ensure those properties are completed first.
And so back to Bill's question with which he began the program here about whether Evergrande is China's Lehman Brothers. I would tend to agree with you, Bill, that there may be more apt analogies to the U.S. experience. A Bear Stearns or AIG type rescue comes to mind.
Or even HNA recently in China.
Mm-hmm. Okay.
A controlled wind down where the principals were made examples of. I'm not sure that's going to happen in Evergrande. It will happen probably with one of the other property companies, but HNA has been being unwound now. We lost track of it for almost 6 years, and they've quietly done a fairly good job of it without ever having to file a formal bankruptcy anywhere.
Right, and of course Evergrande gets all the attention, but once again the attention within China is as much or more on the real estate and housing sector as a whole, the industry-wide effort to deleverage the large developer companies.
So, the two of you are the bankruptcy lawyers here. I mean, I hear endless speculation that Evergrande will file someday. Singapore, Hong Kong, London, maybe Part 26A. I don't see any of that happening. I see if they file, they do something under the new Chinese code in Shanghai. You guys feel the same, or you feel differently?
I think that's an almost impossible proposition to disagree with. It's almost like the parlor game that you could play and that bankruptcy geeks like at least the two of us, well, three of us, like to play about Delaware, New York, Southern District of Texas for domestic companies. This is not going to happen anywhere but China. I don't think that it will happen at least anytime soon in terms of an actual filing for restructuring. I think that there'll be other efforts of the type that you've described so far to restructure and reprice the various debt at various levels within the company. One device is a government formation of a creditors committee, which is an out-of-court process that exists in the PRC through which banks and trust companies on a sort of like a composition of creditors bill could work to extend loan maturities, reduce lending rates, and offer other support. And again, this isn't just about Evergrande or about Fantasia. Some companies may be allowed to fail.
Smaller ones.
Smaller ones. A friend familiarized me with...
It's always wise to shoot a peasant, as we say in our industry. If the noble rides out from the castle and offs the peasant every so often, it keeps the rest of the peasants in line.
See, Bill likes that metaphor. A friend of mine in China told me that there's an expression that they use over there of the same type: kill the chicken, spare the monkey. and I'm not exactly sure which is which, but you get a sense of how they may go with it. John, your thoughts on this?
I agree that any resolution will take place in the PRC. I think we'll see what happens with Fantasia. I heard that, there are creditors that are formulating potentially a wind-up petition in Hong Kong. We'll see if that gets any legs and if it goes anywhere. Honestly, I don't think, even if liquidators are appointed, I don't think it's going to have an impact on any of the liquidation of the operating assets.
Well, we're at the point in China where the court in Shenzhen, which is just across from Hong Kong, is actually entertaining the first ever motion to recognize a Hong Kong bankruptcy in China. And that's been a codicil, a protocol they've been working to for a long time. So the process could be, if you did try and appoint JPLs in Hong Kong, and of course, for those of you who know Hong Kong, the Legends decision, which is famous in Hong Kong, basically prohibits a JPL from doing a financial restructuring. They can only do a wind down. There are workarounds around it, but I think, frankly, under the new PRC code, you would likely see this, if there was a winding up filed in Hong Kong, it would get transferred to Beijing or Shanghai under the new protocol they're trying to establish. But the government would take control of it at some point.
I agree with that.
I do as well, and only since I mentioned at the outset that we would at some point try to take our focus a bit outside China. Let me just mention that the problems in the real estate sector that we've been talking about in China are by no means unique to China and its economy. As one recent example, you see a restructuring of Indonesia-based Modern Land, which, like many Indonesian companies, used a Singapore pass-through to issue its debt, dollar-denominated debt, and I believe there's another class of debt there as well that may have been traded on some other exchanges. And so, like a lot of companies that have used that structure before, Modern Land was faced with a choice between a Singapore scheme and an Indonesian PKPU proceeding, Chapter 11 type proceeding with a bit more strict requirements in some levels, in order to be able to restructure that debt. There was some concern about the use of the PKPU due to recent experience in the Southern District of New York that I had a lot of familiarity with, for better or worse, and that was the P.T. Bakri case, where the court declined to grant relief in aid of an Indonesian PKPU that was conducted in a manner that I think most of the people in this room would find as somewhat irregular. Notwithstanding that, there have been since then two other Indonesian PKPU proceedings that have been properly conducted with rights of bondholders preserved in Indonesia, and they've had no trouble getting recognition in the U.S. and relief as necessary to implement through Chapter 15 a restructuring of the New York law-governed and U.S. dollar-denominated debt. That's a textile company called PT Delta Dunia, and also the Modern Land case, which involved one of the largest real estate developers in Indonesia. So, I don't know, Asia or China, closing remarks?
Well, I think we're at a distressed investors conference, and the two of you, if you were asked, and John, I start with you, by the people you often counsel with respect to their investments. I'm reminded that George Soros had an opinion piece in the Wall Street Journal, as I mentioned at the top, 2 months ago, saying it was not only unpatriotic to invest in China, but just flat crazy from a financial standpoint, given these housing bubbles. John, what do you say to your investors about that?
Well, look, I'm not as smart as my clients when it comes to investing money, but my job is to point out the risks. It's their job to say, to determine whether they're willing to take that risk. And I think a lot of the investors saw this as an opportunity, some option value, make a small investment, and see if they can make some returns. But I think it's not going to be an easy investment.
My investment advice is so widely valued and regarded that my wife makes all of our personal investment decisions, and I don't interfere. I will say, though, that like anything else in the market, it's a risk-reward issue. And where you can buy something at the right price and do it as part of a portfolio that may be spread over a number of different sectors, a number of different countries, in order to be able to manage risk and diversify the portfolio, I think there always will be U.S. dollars, particularly with all of the dollars sitting on the sideline these days. There always will be U.S. dollars willing to chase value in these investments.
But I think the takeaway from our panel is if you are a U.S. investor or you are investing in the U.S. or international bonds for any of these property developers in China, expecting the government of China to come forward and say, look, we want to make sure you guys get paid so you'll invest in our future deals. Not going to happen, okay? So at that point, if you need wallpaper for your bathroom, those bond certificates will be perfect. You can stare at them and think about what might have been. And with that, let me wind this up and remind you we're moving at 11:45 to the Harvey Miller Annual Awards Luncheon, which is one floor up, and I look to see you all there. Thank you very much for your participation.